Hi, this is Jim Cunningham. We're going to talk about year-end oil and gas investing, a tax mitigation strategy. There are methods where you can deploy your capital in a specific way that generates a tax benefit. So we're going to talk about that. We're going to talk about when you invest $1, kind of discharging about 31.5 cents in federal tax, so that your net at risk is the 1 minus 31. So what would that be, Christina? I don't know, about 69 and change or 68 and change. So it's very important. This is one of the very few tax strategies that W-2 earners can utilize. Now, business owners have a lot of strategies. Also, business owners use this strategy as well. But what we're going to talk about is how oil and gas investing works and the tax benefits of oil and gas investing. So if you're watching this on YouTube, we are doing this live. We do these live every Thursday. Check out our website. You can sign up for our next webinar. I think we've got one coming up next Thursday. And if you're watching this on YouTube, please post your question on our YouTube page. And we do answer. I actually look at those questions and answer them personally. So I'd really encourage you to put a comment on there, and you can put your question in the comments. If we're doing this live, this is a webinar. You can put your questions in the Q&A, and we will answer your questions. I'm Jim Cunningham. I've been a lawyer for over 30 years. I'm a certified specialist in estate planning, trust, and probate law. So our firm, Cunningham Legal, is involved in all things peaceful transfer of wealth from one generation to the next while minimizing taxes during your lifetime and when those assets transfer. I'm also a real estate broker. I'm securities and insurance licensed, as well as a pilot single engine land instrument rated, although I'm not current. So for you pilots out there, you know what that is. And if you're not a pilot, I think you might be able to guess. So I just can't hop in a plane and go fly with somebody. I've got to do 3 takeoffs and landings successfully, Christina. So we've got a bunch of lawyers here, again, dedicated to all things peaceful transfer of wealth. And this is the team from Ascent Wealth Management. I'm invited them here to our YouTube page to talk about oil and gas and the tax benefits of investing in oil and gas. Now, if you happen to be watching this in 2026, there's still oil and gas around in 2026, but we're looking specifically at 2025 because this is very time sensitive. So Christina, if you would like to talk about, well, I'll do the disclaimer. So I'm a lawyer. My lips are moving. Words are coming out of my mouth. If I talk about something legal or if I'm talking at all, this is not legal advice. When I say you, there's no attorney-client relationship by using the term you. I am here to teach and hopefully be somewhat mildly entertaining because this stuff can really put pretty much everyone to sleep. Christina, you want to talk about your disclosure?
Sure. Thanks, Jim. Yeah, we are registered representatives. We are registered with FINRA. We are also investment advisors registered with the SEC through Cooper McManus. And so every investment that we discuss on an individual basis is going to need to be determined that that's in the best interest of the client. We are fiduciaries and required to act in the best interest of the client. So this is not individualized recommendations. This is certainly not a recommendation to purchase or buy a security. So we want to make sure that we do that with context of your individual financial needs. This is just for information purposes only.
Yeah, and really the point of this is to explain how this works, not whether it's appropriate for you. But if you're interested in it, if you're like, hey, how can I pay less tax? How can I pay less income tax? It's 2025. You might be a business owner and you're like, man, I'm either going to take this massive paycheck out of my business at the end of the year, or I've made those quarterly payments and I'm just really sick and tired of sending money to the federal government. The state government, we'll talk about that benefits over a 5-year time period. But really what we're talking about here is deploying capital, investing money in a way that does 2 things. One is there's a return on your investment, hopefully, and a return of your investment, hopefully, and we'll be talking about how that works. The other one is also paying less tax for tax year 2025. Now, if you happen to be in 2026, it would be paying less tax for tax year 2026. So this is fundamentally, I would say, an investment strategy coupled with a tax deferral strategy and a tax reduction strategy. So if deferral and reduction and in return on your investments sounds great, you're in for a real treat because this is really great content. Christine and I talk about this stuff all the time. This is one of the many things we talk about quite frequently. But Christina, I will turn it over to you. Maybe explain what's going on with what we're talking about here with investing in oil and gas.
Yeah, we're going to talk about the mechanics of the investment itself and what the tax benefits and perks are. But before we get into that, we want to conceptually understand what the underlying investment itself is. And the underlying investment itself is in oil and gas. And oil and gas provides oil and gas production, drilling, does provide one of the oldest tax benefits other than charitable giving in the tax code as it stands today. So it is something that is incentivized in the IRS tax code and the IRC and the Internal Revenue Code. And where most of the oil and gas drilling takes place in the United States is in the Permian Basin. It is one of the most prolific oil basins in the world. And that's going to be West Texas. It's going to be Midland, Odessa, Carlsbad, Hobbs, New Mexico, in the southern corner of New Mexico. So, New Mexico, West Texas, and occasionally also in Oklahoma. But that is really where the main focus of this in the Permian Basin. And I've been out there myself. I've gone to the oil and gas rigs and gone to the headquarters of a couple of the companies that we work with out there from an investment provider perspective. And in the Permian Basin itself, it is very brackish. It's old salt beds. So it is not any of the drilling that takes place in those regions. They've been doing so for over a century, and the regulations and environmental controls are very stringent, and it is a salt bed. So it is not in potable water that you're contaminating or fracking near water sources for drinking water. This is where people live. This is where the people that work in the oil fields live. They're certainly very environmentally conscious about where they are drilling because that's where they live. And where you kind of heard some of the issues with regards to, the Matt Damon movie and the things that, contaminate water sources, a lot of that took place in the Northeast, in the Pennsylvania and the Appalachian. Those are areas that were newer for drilling, and they didn't have regulations or know what to do with dumping the water that comes out of the ground when they're separating the oil and the gas from the water and particles. And they had dumping issues where they had no regulations. And so where the Permian Basin lies, this is an area that they've been drilling and drilling soundly, environmentally friendly way for a very, very long time.
Yeah, I happen to have been in a conference in Dallas earlier this week talking to a person in the oil business who made the comment. Now, I'm not going to say this is true. I'm just saying I heard it, that when they drill a well, they leave 90% of the oil there. So this is in response to a question of, well, gee, what if they get a dry well? What if I invest and there's no oil coming out of the ground? Do I lose all my money? What we're seeing now is fracking is going back into the proven oil areas so that, they know that 90% of the oil is still there. So they do some fracking, maybe they get another 5% or something
They
like
can
that.
do directional drilling where with
Yeah.
the geology testing that there is today, that if you look at some of the headquarters, and again, I've been to these headquarters of a couple of the organizations that we work with, and you've got graduates from Texas A&M, you've got graduates from different universities there that they have the best technology in um, geology, their reports, they're able to understand how many layers of shale there are to still drill. They have not drilled a dry hole in that region since 2009 because of the technology and the geology reports that are proven reserves. It just doesn't happen anymore. They're not going out and wildcatting
Yeah,
and trying to find or strike oil.
yeah, there's too much known oil. That's just why would you go out and wildcat? So
Mhm,
that's kind of how it works. Great.
mhm. So the demand for energy, that is probably the greatest question of today. And it's interesting. For if anyone has seen the movie or the series Landman, yeah, Billy Bob Thornton, it was really well done.
Yeah.
There was a lot of accuracy to it. Those are definitely older wells that are not current modern rigs that they were working on. But there was a lot of wisdom in some of the things that they had in the show, and one of them is, can we rely solely on wind, solar, and clean energy sources? No. And even as we have more EVs and more other clean energy sources, and you have all the big oil companies that are also looking at alternative sources of energy, oil is still continuing to rise. Demand for oil each and every year it kind of just moves with population. So it is something that is required for a high standard of living,
Well,
period.
the other thing too is this demand for energy for AI. This has been in the news a
Correct.
lot lately, and this is really going to increase. And there's a lot of politics attached to production of energy, and all the smart kids are saying we need all of it. We need oil, we need solar,
Absolutely.
we need wind, we need whatever it is. We need it because we just
And
simply
you
don't
need
have enough.
oil for every bit of production of
Oh,
EVs,
for
every
sure.
bit of production of wind and wind farms. So oil is also required to power a lot of these other clean sources as
Yeah, I'm
well. So
assuming my vegan leather in my Tesla is oil based. I'm going to have to assume. I don't know what else it would be. So.
demand for oil is not going anywhere. The global demand continues to rise by over 1 million barrels a day. And so it just is not, it's not really something that is up for debate of whether or not we're going to continue to have reliance on oil. It's something that, whether it be deodorant, whether it be iPhone production, whether it be jets and airplanes or whatever it might be, we are going to continue to need oil. And there's abundant reserves, and to do so in a very environmentally friendly way that does provide tax incentives to U.S. investors for drilling domestically. I think this was just a funny, we also saw this during the cold spell. I think that there's actually an interesting demand for hybrids now, just
Yeah.
because the demand for EVs, the adoption rate of EVs has kind of already hit that like saturation, if you will. You're kind of starting to see more demand now for hybrids.
Yeah, and I know you have a plug-in hybrid, don't
I
you,
have a plug-in
Christine?
hybrid.
Yeah, I had a plug-in hybrid. I really liked it, and then I got a Tesla, and I like my Tesla, but I live in a city, so I just plug it in my garage and I just drive around. But if there are different use cases, right? So I'm a pilot, and your aircraft has to suit the mission. I think some people hybrids make sense. Some people electric makes sense. Some people, just straight up fossil fuel makes sense. It just depends on what the vehicle's doing.
Yeah. So even though we do see continued rise of demand for EVs, they're certainly not replacing fossil fuel, just adding to the overall mix. And so when we look at the different layers of shale, and this is kind of similarly what shale looks like as you drill through different layers of the earth. But this also illustrates the demand for oil, natural gas, coal, wind, solar, biofuel is a very, very small percentage. I think wind is becoming less popular, not as reliable, but you're going to continue to need more and more energy for data centers and AI. And I think that that is something that will continue to drive the demand for consumption of energy. And so, supply and demand, this is also something that the US, because of our high standard of living, and we just have a very high quality of living in the United States compared to some other countries and certainly third world countries, but our consumption is quite substantial. So, I think it just puts it in perspective as far as where things lie with consumption. And data centers, we keep talking about it.
Yeah.
AI, the demand for energy for these AI, I mean, cryptocurrency, mining, whatever it might be, every single thing requires energy. Data centers, iCloud storage, any form of storage. I mean, how many people were affected by the Amazon outage the other day with their
I
web
think everyone.
services?
Yeah.
So, but continues to demand energy. Most important is there's going to be continued demand for how do we source this, and it's going to be multiple forms of energy production.
I guess a great question for AI is, given the spend on AI chips, how much data
Mhm.
will that consume? Where will it consume the data? And how are you going to supply the electricity? I think
Mhm.
you're kind of stuck with solar and wind. It's only generating so much energy. If you want to generate more energy, maybe fossil fuels. I don't know. Who knows?
Yeah, it's going to be a combination of
Yeah.
all the above. I mean, I think nuclear is back on the table. I think what was it, Microsoft and
Yeah.
looking at buying old nuclear plants and restarting that again. So there's just going to need to continue to be energy to keep up with it's the new industrial revolution, if you will, of the United States is the AI data, how that's going to play a role in our economy. So when it does come though to drilling, I think that there is a demand and high focus on environmental considerations. Certainly in the Permian Basin, as I mentioned, they've been doing drilling for over a century, and they have very stringent regulations. I've been boots on the ground. I've seen how they do these the well designs, the air quality emissions, the water, how they recycle their potable water, because again, these are old salt beds. So anytime that you're extracting oil and gas from the earth, it's going to come with water and other particles. And so there's a way to separate that, filter that. And rather than just dumping the water and not using it, it's salt water, it's brackish. It can be recycled into potable water for open spaces, agriculture, those kinds of things. And so that is one of the things that they are very good at doing is using recyclable water and making sure that they're good stewards of the resources that they are pulling out. The other thing that was very fascinating to me, being again on the oil rigs and seeing how they do everything when they're first drilling the initial holes, it starts with like maybe a 12-inch, maybe that's probably not quite as big as that, but maybe it's like 8 to 10-inch diameter piping that goes down into the earth. Then there's another, call it 4-inch diameter circular piping that goes through. And then there's an additional probably 2-inch circular circumference that all the oil comes through from each layer, from the 8 to the 4 to the 2. So from the 8 to the 4, there's cement that they then quick dry cement that they put through the piping to make sure that no spillage can seep out of 2 layers of steel when they're doing all the drilling. So it's very methodical in all the different layers of environmental checks and balances.
It's very expensive too. We're going to talk, and that's why they need money, right?
Mm-hmm.
All this is really expensive.
It is expensive, although it's impressive what they've been able to do because of the directional drilling and fracking, and that they can go multiple layers in the same shale, and they don't have to fully take down a rig now to then set up another rig. So if they're drilling on one spot and they have to then move the rig over, call it 50 yards to the next location of drilling, they used to have to take down the entire production and then rebuild it. And now they can walk them. The rigs actually have like mechanical, feet that they can, like a robot, move the entire rig over. And just the amount of savings that's created as well. They've gotten way more efficient. West Texas oil, the WTI index, that's the West Texas index for crude oil prices, has been incredibly range bound. That is what derives the income that comes out of all the well production and royalties, if you will. If you were to invest in oil and gas, and if you own fractional interest in a particular year's partnership that has 100 wells, say, for example, in that, as they're drilling and then selling off that oil production to the big corporations or the end users that are purchasing, whether it be some of the big names, it could be Royal Dutch, it could be Exxon, Conoco, Chevron. So all of those are potential purchasers of that oil. What drives the revenue back to investors is also going to be a function of the oil price. So that's one thing that the West Texas Index has been pretty stable. They can cash flow at $35 a barrel. Anything below that, they'll cap the well. They won't sell their resources into a negative priced market. So when we saw 2019 oil price, or sorry, 2020, really, when we saw 2020 during COVID, oil prices go negative because no one was going anywhere, they cap the wells. They don't sell their resources into a negative priced environment. Most of the pro formas and modeling as to how these investments are modeled is based on a $55 to 65, $55 to $60 per barrel price of oil. And if it stays in those prices, we're going to hit our targets. And we've been kind of hovering around that 72 for quite some time.
Yeah, and there's kind of an XY axis on this. If you're trying to digest this and figure out if this is right for you, there you have the price of oil minus the cost of extraction. So the higher the price, the more money you're making. As the price drops, obviously you're making less. But once it hits this point where you're not getting anything if you pull the oil out of the ground, right? It doesn't make sense to pull it out of the ground because you're losing money. So they cap the well and you wait, right? You wait till prices come back up. And historically, that's been the pattern.
Yeah, and I think that this is
Yeah,
also something that is important because I know this is not a political conversation. We've got
yeah,
both sides of the aisle with many clients on both sides of the aisle that invest in this every single year. We work with partners that are in the Permian Basin that have 30 to 50-year track records of operating in those markets, and they're used the corporations are used to working with the politicians and administrations, and both federally and locally with both parties. And if you've got a lot of the production in New Mexico, which is a very purple state, and you've got a lot of the production in Texas, which is a red state. And even in New Mexico, you've got to work. They know that a lot of their employment, a lot of their tax revenue, a lot of their jobs are from the oil and gas industry. So you have to be able to navigate both sides of the aisle. There's still demand for oil. And this is something that has been pretty consistent, regardless of who's in office.
and then I want you to talk about this. I also want you to talk about when the dollar's invested in oil,
Mhm.
how long does it take until your investment, all of your investment is returned? So not only your invested capital, which you're putting at risk through the investment. By the way, when I say at risk, every investment, there's risk. You buy a
Mhm.
stock, there's risk, right?
Absolutely.
So you
Yeah,
put your money in.
let me
Yeah.
walk through the timeline
Yeah.
of an investment and how it works. It might
Okay.
make a little bit more sense when we talk about kind of the tax incentives as well. But ultimately, each year, a lot of the oil and gas companies that we work with, and we're not naming specifics here just because there are a couple different companies that we work with, and we're not trying to sell a particular product. So if we name a company, it's because we're naming a particular product, and that's not what we're here to do. We're trying to keep this informational and educational. But if you invest in a particular partnership with a company that we work with, and we do vet several of them, we're very particular, only working with a handful of oil and gas producers in the Permian Basin, not doing anything offshore. That we're very, very particular in who we work with. And so each year they do a partnership. So there's 2025 partnerships that will close more than likely the first or second week of December. So they will be open for another 5 weeks or so. And the 2025 partnership will close. Then they are drilling, and it will take about 16 months or so to get all 100 wells fully operational. So the first distributions to investors will take place after the end of first quarter next year, because it's going to take time to get wells drilled and in a position where they're selling to the end user and generating oil. And then the life expectancy of the investment is about 10 to 12 years. So again, if you invest today, some investors invested back in, August, September. First distribution's not till after first quarter. It will ramp up. Again, it's not going to be till 16 months later or so that all 100 wells are operating and kicking out income based on the price of oil sales that they're selling that resource to the end user. That's what generates the income cash flow to our investors. This is important because you can keep some option, you can kind of put some guardrails, if you will, which is what an option contract is, where you can put guardrails on the price of oil so that if the price of oil were to get volatile to where it falls below a certain price or goes above a certain price, you might give up a little bit on the upside if the prices goes up significantly. But you're also going to benefit from protecting on downside too, to create some sort of a floor. So you can do a floor and a ceiling or you can do swaps where you can lock in a fixed price. So that gives these oil companies an ability to kind of hedge their revenue stream and also hedge for delivering consistent royalty income to investors as much as possible.
Yeah, it's de-risking. So what it is, if I get this right, so if a barrel of oil trades at $80, it's going to trade at $80. But if oil's trading at 70, the producer is going to still get 73. But if it's trading at 90, they're going to be capped at 84.
If
Right.
they're doing a costless collar,
Right.
correct?
You're de-risking, and people buy those contracts all the time. So
Yeah, it's just kind of like farmers and agriculture, they'll buy contracts on futures and try to lock in their prices. So very similarly, and if we feel the price of oil is heading in a certain direction, they can renew these option contracts on a quarterly or semi-annual basis. So they can move the needle depending on where the puck is going with prices, but it just gives them some protections. So let's talk about why from a tax perspective. So the underlying investment is first and foremost most important. There is a return on investment from the oil production. So I think that is important, is letting clients know that we don't like to recommend ever an investment that is just for the tail wagging the dog on taxes. So if the underlying investment itself isn't a sound investment, it's not something that we typically would consider. So this is a cash flow oriented investment. It is diversifying into something that is not stock market driven. It's not liquid traded stock prices. It is an alternative investment, investing in energy, but it comes with significant tax benefits. There are a couple tax benefits that have been in the tax code for a century. And so this is not something that gets kind of discussed of, is this going to come out of the tax code with this administration? It's been in there. It's been in there for a long time. The
it's too
IDC deduction.
it really is too. It's a strategic move by the U.S. government. We need domestic oil production. Sorry to interrupt you, Christina.
No, yeah,
But this is like the policy of the United States. We need domestic oil production. We don't want to be like Europe where we have to import a bunch of oil. That's just not good.
exactly. So the main upfront benefit is what we call the IDC deduction. It's the intangible drilling cost deduction, and 75 to 90% of the upfront cost of drilling that well, the partnership's wells, is passed on as a deduction to investors, because investors are participating in U.S. oil production. Therefore, they're taking the risk. Therefore, they're getting the benefits. So if you invest $100,000, you are going to write off 75 to 90% of that upfront cost, depending on which investment we're participating in. And so upfront, if you invest $100,000, you're writing off 90% of that, $90,000. So if you're in a state of California and you're in a high tax bracket, realistically, you're getting $45,000 of tax savings on $100,000.
Now,
And that can
California happens over 5 years, so just understand. So
Yep.
a lot of
Let's
people do these annually. They do it a bit every year. So if you do it for 5 years, then you're essentially getting your full state deduction.
Yeah, so let's break that down a little bit further. So the IDC deduction, that works against highest cost, highest taxed income. So if you have ordinary income, it could be 1099, W-2, K-1, business owner income. It could also be RMDs from an IRA or portfolio income. So anything that is taxed at the highest rate, this can offset that federal
Or a Roth
tax.
conversion. If someone's doing a Roth conversion, and you have,
Correct.
right? Yeah.
Well, yes, that's passive, but
Yeah,
yes,
so
it
you
would
do
be taxed as
LP,
ordinary
right.
income. Yeah. So this is something that is federally, you're gonna write off in the year of investment. So if you invest between now and year end, you're gonna write off federally 75 to 90% of that investment. Most states, you can also take that write-off for benefits for both AMT, and in most states, you take that write-off in the same year. California, as of last year, decided to change that to being over 5 years. So you still get that 90% write-off, but it's going to be over 5 years, not all up front.
Although Newsom, I think he's running for president. we may get that back. Who knows? I think he's changing direction on stuff. So anyway, this is not a
Yeah.
political discussion, but the point is California took that away in 2024.
Yes.
So you're stuck with a 5-year. You're going to get it, assuming you have income in the next, 4 years after 2025. You're just going to have to wait to get that benefit. But that's how, frankly, and let's just step back, like take a 30,000 foot view level. What we are talking here is part investment. We're also talking part tax planning. I think people too often, Christina, we see this, they make the mistake of thinking tax planning is an event that happens every year. You just look at this 1 year and I'm doing tax planning. A lot of this tax planning is done over a period of years. So the true benefit you realize over time. And so I think a lot of times we get sucked into this false belief that tax planning is just for a given year. But if we take a longer view, maybe 5 years, 10 years, 15 years, if you look at this horizon, this is how I've seen my clients that come to me who are incredibly wealthy. And I just look at them like, how did you do this? Well, a lot of the time they're thinking in multi-year segments, right? They're not just thinking this year. So I think this, when you're talking state income tax benefit, I think this falls into the multi-year bucket. Federal tax benefit, single year bucket. And then also maybe talk about once this money comes in. Let's say I invest $100,000 and then I get $200,000 of income over a period of time, maybe, I don't know, 10 years, whatever it is. I'm just using this as an example. What's my tax rate on that $200,000?
Yeah. So you kind of hit on 2 points there. One, what's the expected total return and how is that taxed? So
Yeah.
you get the upfront deduction, that's the IDC. Then you have a depletion allowance, and that shelters 15% of the income that is coming back. So as that royalty income, if you will, as coming back to the investors and you're getting cash flow from those wells, it is a depleting resource. And so the IRS does not tax all of that income. There's a 15% shelter. So for every $10 of distribution that comes back, 85% of that, $8.50, is going to be taxed as ordinary income. But the first 15% is not taxable. And so when a client invests with most of these, the way that they're modeled, there are some nuances depending on which provider we're working with. So I'm not going to get too granular here on specifics, but general rule of thumb is if you invest in a partnership, usually it's going to be in the second half of that year. So we're talking 2025. First distribution will start at the end of Q1 2026. It will ramp up, and that will probably take until Q1 2027 before you're getting kind of consistent distributions. So you kind of see this bell curve where you ramp up and then you hit peak about year 5 to 7, and then it kind of starts to taper down over the life expectancy is 10 to 12 years. At $55 a barrel, most of these are going to be modeled to break even cash on cash return to investors within 5 years. So if you invest $100,000 aside from the tax benefits, the expectation is typically going to be $100,000 within 5 years. Over the lifetime, 10 to 12 years, we're talking 1.5 to 2x, and it will vary depending on the prices of oil and the season in which you invest. And so that's why we do have a lot of clients that invest year over year. We've got clients that invested through, 2017 and 18. They hit a little bit more of that lull in 2020.
Yeah.
And then you had some clients that invested in 2020 that caught that huge spike in price of oil and had a little bit of a quicker return of capital. So it just depends because it is somewhat fluctuating based on the price of oil. But I've been working with a lot of these providers for over a decade. I have not yet seen it take more than 5 years, cash on cash, break even.
Yeah, I remember talking to some clients. They go, "Yeah, I invested in oil and gas, and I got more money too fast, almost like I got it too fast, and it's generating too much income." Yeah, it's a good problem to have.
Yeah.
So, but I guess and you said something important. That assumes a $55 per barrel price target. Which when has it been $55 a barrel? It's been a while. Yeah.
It's been a while. Yeah. So, and that's really one of the risks though, too, is, as far as what are the risks, and I tell people there is time and seasons where you could go through a 2020 where for 6 months they capped the wells. In 2015, believe it or not, we had below $35 a barrel. It was like 29 for a good period of time. So those are times where, again, it could be a 6-month period of time where there's no income.
And so I guess, you're a CFP and we're talking complete hypothetical. let's say somebody had, I'm just going to give a number. Let's say someone had 10 million, and this just makes the math easier. I suppose you could say a million, but maybe the numbers wouldn't be big enough. If someone has 10 million invested, how much should they be putting into oil and gas? Should they be putting 5 million? Should they be putting a million? Should they be putting 100,000? What's an appropriate on like a typical, the financial plans that you're seeing? And I know it varies from people to people, but where I'm going with this is this tends to be a pretty small part of people's portfolio.
Yeah, it's really honestly, it goes back to that three-legged stool that we
Yeah.
always preach, is that this requires coordination with your CFP, your estate planning attorney, and your CPA. And in particular with these, it's really the CPA and the CFP, most importantly, because it's an income tax mitigation. So we had, for example, we had several clients that sold practices and businesses last year that had extraordinary amounts of capital gain income. Now, they also had high W-2 and
Right.
business income. So, cap gain, this can still move the needle, but we really were able to solve for other tax strategies to deal with the cap gain and use this as a piece of how do we get your highest taxed income that's taxed at ordinary rates down. We've got clients that have several $100,000 annual RMDs. This is a way to help get some of that tax down.
So you
So,
take that RMD money, invested in,
mhm.
if you're, man, I'm just taking this from the left pocket and put it in the right pocket. I got to take this 100,000 out of my retirement account. I got to pay a bunch of tax. This is ridiculous. That's one strategy, is to put that $100,000 RMD into oil and gas, and that's going to really kind of knock out a good chunk of your federal bill, almost all of your federal bill on that. State's a little bit different. Also, we talk about this totally unrelated, qualified charitable distribution, but that's a whole
Yep.
other
But we
thing.
couple
Yeah,
that. Honestly, I'd
yeah.
say that most of my clients that are taking high dollar amounts of RMDs and have substantial required distributions annually, we're coupling it and we're saying, okay, if we do a little bit of oil and gas and if we do a little bit of a qualified charitable distribution, we can get you into this tax bracket as opposed to this tax bracket. So if we can take you down from a 37 to a 24, great. Or even a 32 to a 24 or a 37, if we can get that down somehow by doing more advanced planning, this is just one of the tools and arrows in the quiver to use as a piece of the strategy.
Another thing too, if you are married filing jointly and earn $600,000 per year in 2025, if that's your taxable income, your federal and you're a California resident, your federal tax equivalent marginal rate of income tax from the $500,000 to $600,000 range is about, I think it's 61%. And here's why. When you earn $500,000 a year, married filing jointly in 2025, you have a $40,000 state and local income tax deduction. If your income is $600,000, you lose $30,000 of that $40,000 state and local tax deduction. So the translation is you're going to pay $10,000 more in federal income tax. So this is very, very important because we're getting toward the end of the year. If you're like, yeah, I think our W-2s are going to be 600,000, I would really encourage you to take a look at ways to get your income down to that $500,000 level, because you won't lose that $40,000 state and local income tax deduction. What are state and local taxes? They're your property taxes, right? On your
That's right.
personal use assets, and they're also your income tax. And a lot of times clients will have a significantly higher state income tax bill than they will a federal income tax bill for a lot of different reasons. But I think this is really important to look at, to do tax planning, not after January 1, but do 2025 tax planning in calendar year 2025, and probably before Thanksgiving, maybe certainly before mid-December. But I think this kind of and this is not like there's no pressure. This is just the reality is this thing closes out just mid-December, Christina. You said early December,
This is probably
mid-December.
like the second week of December
Yeah.
is
Okay.
when this will close for this year. So that's why we're kind of trying to let people know, hey, before the first week of December, let's have a conversation. Let's look at the income sources. Is this something that's appropriate, and what would be the appropriate amount? Because it is going to be, they're typically $100,000 minimum, and it's going to be something that will close before the next 5 weeks, 6 weeks at the very latest. And then we'll have another opportunity for next year. So these are things that come out every year. It's just they're typically going to be in the second half of the year. And of course, because people do their tax planning at this time of year and then realize, oh my gosh, I've got a tax
Yep.
liability or I've got to do something about paying taxes. And this is the busiest time, and it sells depending on how many people invest. There's only a limited amount of capital that they can raise. And then once it's closed, it's closed.
Yeah, and so a lot of clients of mine that are high W-2 earners, let's say you take a couple, they're making $1 million and a half dollars a year. They're paying, the couple that's making $1.5 million is paying half their income in income tax, state and federal.
In California.
In California. I mean, this is like, I think it's sickening for a lot of people, quite frankly. It's like, is there any way I can just give the money to somebody other than the government? And if this is you, this is really important, because that W-2 earning, let's say you got some savings, you got $1 million saved. If you put $100,000 into oil and gas, you're going to pay about $31,000 less in federal income tax for 2025, right? So it's costing you not that dollar, it's costing you, essentially about 70 cents on the dollar. And that's not even factoring in the state benefit. So it's a way to reduce your tax bill. And it kind of reduce your withholding too. That's a whole other, right? So you can mess with your withholding depending on how much you're investing in a tax efficient way. But we cover this in other webinars. But Christina, I want to thank you very much. If you have any questions, please put them in the questions in the or the comments on the YouTube page, and we will have questions when we're done here with the live portion that we will answer live. So if you want to ask us questions live, just come to one of our webinars, and we have those every Thursday at noon Pacific time. But this is really important. I think what I see, how do families create wealth, preserve it, get it from one generation to the next without drama, without a war in the family? How do you protect that inheritance from a future ex-son-in-law or future ex-daughter-in-law? This requires some really significant coordination with your attorney, your certified financial planner, and your CPA or your tax advisor. So, or enrolled agent or CPA, whatever you happen to have. But these three people need to come together to work through these issues to make sure that the income that you earn during your lifetime and the wealth that you're saving, the wealth that you're creating during your lifetime, is that tax hit is minimized and it passes from one generation to the next seamlessly and peacefully. So we have office locations at Cunningham Legal throughout California, Northern and Southern California. So near many people in California. Next webinar, November 6th, we will be covering a very popular topic, which is California Prop 19. We will give real examples of impacts on property taxes. And there have been some new changes to Prop 19, some updates from the Board of Equalization. So if you're interested in property taxation, and paying less property tax, I really encourage you to check it out. Dylan Recht in our Walnut Creek office will also be doing a trust administration workshop, and that's also November 6th at 10 a.m., and that's in our Walnut Creek location. We have the address there. It's 1255 Treat Boulevard, Suite 300 in Walnut Creek, and Dylan, it's a live event. So, I mean, a few years ago, I didn't ever think we were ever going to have a live event again, right? But there's a way to reserve your seat. You can go onto our website and reserve for that. And if you have any questions about oil and gas, investing in oil and gas, please reach out to Ascent Wealth Management. Here's their contact information. And I'm going to open it up for questions. So if you have questions, please write these in the comments. And we look forward to seeing you on YouTube or live in the future. So if you're watching this on YouTube, just keep watching. Another video will magically appear after this one from Cunningham Legal. And Christina, thank you for joining us here today to talk about this very, very important tax and investment planning opportunity.